Hello and welcome. Thank you for joining us today. I'm presenting on behalf of Neybor Consulting, and our topic is FAR Part 28, Bonds and Insurance. This is one of the most misunderstood corners of the federal acquisition regulation, but it is also one of the most consequential. Get it wrong and your bid is non-responsive, your contract award is delayed, or in the worst case, you are personally on the hook for losses you never anticipated. Over the next 20 or so slides, we will demystify Part 28. We'll walk through the headline thresholds you see on this cover slide: the $150,000 Miller Act trigger, the 100% penal sum rule for performance and payment bonds on construction, and the 20% minimum bid guarantee amount. By the end of this session, you will know exactly when a bond is required, who can write it, what alternatives you can use, and which 52.228 clauses will appear in your solicitation. Let's begin. Here is the roadmap for our session. We'll start with the big picture, why FAR Part 28 exists and the three subparts that make it up. Then we'll spend the bulk of our time inside Subpart 28.1, which is the bond rules themselves, bid guarantees, performance and payment bonds for construction work, and the special alternative payment protection regime. After bonds, we'll move to Subpart 28.2, sureties. We'll cover corporate sureties, individual sureties, and the three alternatives you can use in lieu of a surety: U.S. Treasury notes, certified checks or cash, and irrevocable letters of credit. Then we'll cover Subpart 28.3, insurance, including the special rules for cost-reimbursement contracts and the Defense Base Act for overseas work. We'll close with the 52.228 clause family, real-world examples, key takeaways, and a checklist you can take back to your team. So why does this matter? Why are we devoting an entire training to one part of the FAR? Look at the left side. One wrong bond makes your bid non-responsive. FAR 28.101-4 is unambiguous on this. If your solicitation requires a bid guarantee and you furnish the wrong amount, the wrong form, or no guarantee at all, the contracting officer must reject your bid. You can be the lowest, most qualified offerer in the country and still lose because you turned in a $4,950 bid bond instead of the required $5,000. On the right, you can see 4 other reasons this part affects your bottom line. First, direct cost. Surety premiums typically run 1 to 3% of the contract value, and they are paid upfront before you have collected $1 of revenue. Second, capacity. Your bonding capacity set by your surety is the practical ceiling on the size of contracts you can pursue. Third, payment bonds aren't just paperwork. Under the Miller Act, they are the only remedy your subcontractors and suppliers have if you default, because they cannot lien federal property. And fourth, the indemnity agreement you sign with your surety almost always pulls in your personal assets, which makes this a personal risk topic for owners and officers, not just a corporate one. Before we dive into the details, let's get oriented. Part 28 has exactly 3 subparts, and each one solves a different problem for the government. Subpart 28.1 on the left is about bonds. A bond is a 3-party guarantee: you, your surety, and the government. If you default, the surety pays. This subpart tells the contracting officer when to require a bid bond, when to require performance and payment bonds, and how the alternative payment protection regime works for mid-tier construction. Subpart 28.2 in the middle is about sureties themselves. Who is allowed to write the bond? The government accepts corporate sureties listed on Treasury Circular 570, individual sureties who pledge specific assets, and 3 non-surety alternatives: U.S. Treasury bonds and notes, certified checks or cash, and irrevocable letters of credit. Subpart 28.3 on the right is about insurance, which is fundamentally different from a bond. Insurance is a 2-party contract between you and your insurer that protects you. The government cares because under cost reimbursement contracts, your insurance premiums are reimbursable, so they want to control the coverage levels and the carrier. We'll spend the last quarter of this session here. Keep this map in mind as we go. Every rule we discuss lives somewhere on this single slide. These 6 definitions, drawn straight from FAR 28.001, are the vocabulary you will use for the rest of this presentation and for the rest of your federal contracting career. Take a moment with them. A bid guarantee is the security that says, if I am chosen, I will sign and bond up. Withdraw your bid or fail to bond up, and the surety pays the difference between your bid and the next acceptable bid, up to the penal sum. A performance bond protects the government if you fail to complete the work. A payment bond protects your subs and suppliers, and indirectly the government, because if subs aren't paid, projects stop. The penal sum is the dollar ceiling of the bond, the most the surety has to pay. For Miller Act bonds, it's 100% of the contract price. A surety is the guarantor, usually a Treasury-listed insurance company. Notice the surety is liable for your default. That's why sureties are picky about whom they bond. And consent of surety, that last one, comes up every time the government modifies the contract. The surety must consent to keep its bond in force after the change. The bond timeline tells you when each instrument from Subpart 28.1 enters the picture. Stage 1, the bid phase. Section 28.101 requires a bid guarantee anytime a performance bond will be required. Notice the conditional, no performance bond, no bid guarantee. Many contractors get this backwards. Stage 2, award. The contract is executed and the bid guarantee falls away. It has done its job. Stage 3, performance. This is where the heavy iron lives. The performance bond at 100% of the contract price, and the payment bond also at 100%. For construction over $150,000, these are mandatory under the Miller Act, codified in 28.102. For non-construction, the rules are at 28.103, and bonds are the exception, not the rule. Stage 4, special cases. Annual performance bonds under 28.104 cover multiple contracts within a year. Section 28.105 lets the contracting officer require advance payment bonds and patent infringement bonds when warranted. Stage 5, closeout and administration under 28.106. The blue callout at the bottom is the single most important rule of Subpart 28.1. A bid guarantee is only required when a performance bond is also required. Memorize that sentence. Section 28.101 covers bid guarantees. 2 questions a contracting officer must answer: how much and in what form. How much? The amount must be at least 20% of the bid price, but it can never exceed $3 million. So if your bid is below $15 million, the 20% figure controls. Above $15 million, the $3 million cap kicks in. The form. Most contractors use a bid bond on Standard Form 24, but you have options: postal money orders, certified or cashier's checks, currency U.S., treasury bonds or notes, or an irrevocable letter of credit. All of those are acceptable substitutes under FAR 28.204. Look at the worked example on the right. A $2 million construction bid means a $400,000 bid guarantee. The $3 million cap does not bind here. The contractor would submit a Standard Form 24 bid bond, or, if they prefer, a $400,000 cashier's check or an irrevocable letter of credit in the same amount. One final point, per 28.101-1C, if your guarantee is below the required 20%, even by $10, the contracting officer cannot accept the bid. There is no rounding, no good faith forgiveness. Always overfund slightly to be safe. This is the heart of Part 28, the Miller Act regime for construction contracts. Above the $150,000 threshold, the rules are mandatory and inflexible. The statute itself is 40 U.S.C. Chapter 31, Subchapter 3, what we colloquially call the Miller Act. It requires both a performance bond and a payment bond on every federal construction contract above $150,000, with very narrow waivers mostly for foreign country work. The 3 cards in the middle show what those bonds look like. Performance bond at 100% of the contract price. Payment bond also at 100%. And, critically, when the contract price goes up through change orders, the contracting officer requires additional bonds in matching amounts. Sureties don't automatically follow you up. They want a fresh write-up for each price increase. The bottom left example walks through a $5 million road repair contract, bid guarantee of $1 million, the 20% rule from the previous slide. Then once you're awarded, $5 million in performance bonding and $5 million in payment bonding. 2 bonds, both at 100%. People sometimes confuse this and think you need 200% total. You don't. You need 100% on each of 2 separate bonds. The blue tile on the right gives you the standard forms: SF24 for the bid bond, SF25 for performance, and SF25A for payment. The contract clause that pulls all of this together is 52.228-15. We'll see that clause again later. Now let's talk about the awkward middle tier. Construction contracts between $35,000 and $150,000 are above the simplified acquisition threshold, but below the Miller Act trigger. So what does Congress and the FAR do? They created a custom alternative payment regime in FAR 28.102-1B. In this band, the contracting officer has to pick at least 2 of 5 alternative payment protections. The 5 options are on the slide: a payment bond from an individual surety, an irrevocable letter of credit, a tripartite escrow, deposits of certified or cashier's checks, money orders or currency or U.S., treasury bonds, and notes. The horizontal bar at the top of the slide gives you the picture. Below $35,000, there is no bond regime at all. From $35,001 to $150,000, you are in this multi-alternative zone. Above $150,000, you are in classic Miller Act territory. In practice, the most common pairing is the irrevocable letter of credit plus an individual surety payment bond. That combination satisfies the contracting officer's preference 28.102-1. B2 explicitly says give particular consideration to ILC and gives subs a familiar instrument to look to. The takeaway for prime contractors: when you bid in this tier, read the solicitation carefully to see which two alternatives the contracting officer has chosen and price the cost of those instruments into your offer. Section 28.103 is short, but its message is loud. Bonds are the exception for non-construction contracts, not the rule. That blue strip across the top quotes the regulation directly. Agencies shall generally not require performance and payment bonds for other than construction contracts. So when can the contracting officer ask for one? The left card lists the 5 typical triggers under 28.103-2. The common thread is that the government has something at risk that goes beyond a normal supplies or services purchase. Government-furnished property in your possession, advance payments funding your work, progress payments before delivery, or a special interest item, say mission-critical hardware where late delivery has cascading consequences. In those situations, the contracting officer can require a performance bond. The right card shows the payment bond logic. 2 conditions must both hold under 28.103-3. There must already be a performance bond, and the contracting officer must determine that a payment bond is also in the government's interest. If either condition is missing, no payment bond. The standard forms here are different from the construction series. Use SF 1418 for the performance bond and SF 1416 for the payment bond, and the operative contract clause is 52.228-16, Section 28.104 covers a useful, lesser-known instrument, the annual performance bond. Instead of a separate bond for every award, you furnish one bond that covers all qualifying contracts you receive over a 12-month period. When does this make sense? Look at the upper right card. Repetitive supplies or services where you expect to win several awards in a year, programs where each individual award is small, but the cumulative exposure is significant, or recurring relationships with the same agency where bonding each task order separately would be administratively absurd. The lower right card explains the mechanics. The contracting officer sets a single aggregate penal sum for the year. That's the maximum the surety will ever pay across all your contracts in that period. Both you and the contracting officer save the time and cost of writing a fresh bond on every award. The surety underwrites you once, you pay one premium, and the cost is effectively spread across multiple awards. One catch: the bond does not auto-extend. You must renew it each year, and the surety reevaluates your capacity at renewal. If your loss experience deteriorates, your renewal terms may tighten or your aggregate ceiling may drop. Section 28.105 covers 2 special bond types that the contracting activity head can approve when standard bonds don't quite fit the risk. On the left, advance payment bonds. These come up when the government is going to pay you in advance, funding mobilization, equipment purchase, or upfront working capital. The bond is required only if the contract has an advance payment provision and no performance bond is in place. The contracting officer sets the amount based on the maximum unliquidated advance, meaning the largest amount of unrecouped advance money you could be holding at any point. As you deliver and milestones are met, the unliquidated balance comes down, and so does the protective amount. The example I've given is a research contract paying 30% upfront for equipment. Until you've delivered enough output to liquidate that advance, the surety stands behind it. On the right, patent infringement bonds. These are unusual but important. They are required when 3 conditions stack. The contract provides for patent indemnity by you, no performance bond is furnished, and your financial responsibility is unknown or doubtful. The classic case is a new entrant manufacturer of a defense item with a broad patent indemnity clause, where the government wants assurance that if a patent holder sues, you can actually pay the indemnity. If you're a small business in either of these situations, talk to your surety early. These specialty bonds are not always inside your standard surety's appetite. Now we move from bonds to the parties that stand behind them, sureties. Subpart 28.2 has 3 relevant sections. 28.201 sets the policy, 28.202 governs corporate sureties, and 28.203 governs individual sureties. The 2 cards capture the key differences. On the left, corporate sureties, which is what 99% of federal contractors use. The Treasury Department maintains Circular 570, the official list of acceptable corporate sureties along with each one's underwriting limitation, the maximum penal sum that surety can write on a single contract. If your contract exceeds the surety's limit, you can layer through coinsurance or reinsurance. On the right, individual sureties. A natural person can stand surety, but they must pledge specific assets on Standard Form 28. The pledged assets must equal or exceed the bond's penal sum, and the contracting officer has wide discretion to determine whether the assets are acceptable. After abuses in the 1980s, the rules tightened, and today individual sureties are rare and tightly scrutinized. Most agencies discourage them outright. The blue strip at the bottom is the operational tip every program manager should burn into memory. Always verify your surety on Treasury Circular 570 before submitting your bond. A bond from a non-listed corporate surety, even one licensed in your state to write surety, is non-compliant for a federal contract. We've seen contractors lose awards over exactly this oversight. Section 28.204 gives you 3 alternatives to using a corporate or individual surety. These are critical for small businesses that don't yet have a surety relationship or for one-off transactions where buying a surety bond is uneconomic. Alternative 1, Deposit U.S. Treasury bonds or notes. The instruments are pledged at their par value, equal to the bond's penal sum. The legal authority is 31 U.S.C. 9303 and Treasury Circular 154. The benefit: the bonds keep earning their coupon while pledged. The downside: you tie up that face value capital for the term of the contract. Alternative 2, cash, certified check, cashier's check, bank draft, postal money order, or even currency. Yes, currency. The government holds the cash for the term of the bond. Simple, but the opportunity cost on tied-up cash is real. Alternative 3, the irrevocable letter of credit, or ILC. A bank issues a conforming letter of credit equal to the required penal sum. Note that you need a separate ILC for each bond. You cannot use one ILC to cover multiple bonds. The ILC is often the contractor's favorite alternative because it doesn't tie up cash. The bank charges a fee on the face value, typically 0.5 to 1.5% annually, and your line of credit is encumbered but not drawn. In practice, the irrevocable letter of credit is the most used alternative for sophisticated mid-sized firms and certified check for the smallest contractors who don't have a banking relationship that supports an ILC. Subpart 28.3 shifts our focus from bonds to insurance. They are different instruments solving different problems. Look at the upper comparison. A bond is a 3-party guarantee. You sign, your surety signs, and the bond runs to the government. If you default, the surety pays the government, and then the surety comes after you for reimbursement under the indemnity agreement you signed when you got the bond. Bonds aren't risk transfer. They are credit assurance. Insurance is fundamentally different. It is a 2-party contract between you and your insurer. When a covered event happens, a workplace injury, a fender bender on a job site, property damage, the insurer pays out under the policy. There is no recourse against you. The premium is the price of transferring that risk. Below, you can see the typical minimum coverages required under 28.307-2 for cost reimbursement contract. Workers' compensation at the statutory level set by your state. Employer liability at $100,000. General liability at $500,000 per occurrence for bodily injury. Auto liability at $200,000 per person and $500,000 per accident. And if your work involves aircraft, $200,000 per passenger. These are minimums. Many contracts require higher limits for specific risk profiles, and high-risk work, explosives handling, aviation, overseas, has its own coverage rules. Section 28.305 deals with overseas workers' compensation, which is its own regime. If your contract puts U.S. civilian employees on overseas military bases or public work projects abroad, this slide affects you directly. The illustration on the left captures the Defense Base Act, which is a federal workers' comp scheme that applies to civilian employees performing under contracts outside the United States. It overrides state workers' compensation because state schemes don't reach across borders. On the right are the 2 operative clauses. Clause 52.228-3 is the standard one, workers' compensation insurance under the Defense Base Act. The contracting officer inserts it in any solicitation where the Defense Base Act applies. Most overseas public work contracts, and contracts financed under the Foreign Assistance Act of 1961, with narrow exceptions. Clause 52.228-4 is a backup. When the Secretary of Labor specifically waives the Defense Base Act for a particular contract, the contracting officer instead uses 52.228-4, which requires an equivalent commercial workers' comp policy plus war hazard coverage. If you bid on overseas work, 2 practical points: get DBA-approved insurance early. Only a small set of carriers write it and price the premium into your indirect rates because DBA premiums for hostile zone work can easily exceed 5% of payroll. Sections 28.306 and 28.307 set very different insurance rules depending on contract type. Understanding the distinction protects your margin and keeps you compliant. On the left, fixed price contracts under 28.306. The FAR generally does not impose insurance levels here. The reason under fixed price, the contractor bears the risk of loss, and insurance cost is just one input to your price. The contracting officer may require evidence of specific coverages where the risk justifies. Aircraft work, hazardous materials handling, proximity to government property, but otherwise you choose your coverages and the government is largely indifferent to your premium. On the right, cost reimbursement contracts under 28.307. Here the dynamics flip. Because the government reimburses your insurance premium as an allowable cost, the FAR imposes minimum coverages and limits on what it will accept. Section 28.307-2 enumerates the levels we saw a few slides back. Statutory workers' comp, $100,000 employer liability, $500,000 GL, and so on. If you want to use a group plan, you must submit it for approval under 28.307-1, and the plan must include a sharing arrangement so the government participates in refunds and credits. Bottom line, on the dark blue strip, 28.308 also lets sufficiently strong contractors self-insure with agency approval, treating actual losses as costs of doing business. That can be more economical than premiums for very large, stable firms, but most small and mid-sized contractors are not eligible. If you only remember one slide from this whole training, make it this one. The 52.228 clause family is your in-solicitation cheat sheet. When you receive a solicitation, run a text search for the string 52.228. Whatever clauses come back tell you exactly what Part 28 requirements you'll be subject to, and you can use this table to translate. A few highlights. 52.228-1 is the bid guarantee clause. If you see it, you know you'll need to submit a bid bond. 52.228-3 and -4 are the overseas workers' comp clauses we just discussed. 52.228-5 is for any work performed on a government installation, which is more common than you'd expect, since it can apply even when you're at, say, a Census Bureau facility. 52.228-13 implements the alternative payment regime for mid-tier construction. 52.228-14 governs the use of irrevocable letters of credit. And the two big ones, 52.2.228-15 and 52.228-16, implement performance and payment bonds for construction over $150,000 and for non-construction respectively. Print this table. Tape it next to your monitor. It will save you hours every solicitation cycle. Let's bring everything together with a worked example. Acme Builders is bidding on a $4 million Army Corps of Engineers levee rehabilitation contract, with about $400,000 of government-furnished property anticipated. Walk through the 4 steps with me. Step 1, bid guarantee. Because this is construction over $150,000, a performance bond will be required, and that triggers the bid guarantee requirement under 28.101-1 and Clause 52.228-1. 20% of $4 million is $800,000, well below the $3 million cap, so the answer is $800,000. Step 2, performance bond, required by the Miller Act and Clause 52.228-15. The penal sum is 100% of contract price, so $4 million on Standard Form 25. Step 3, payment bond, also required by the Miller Act, also via Clause 52.228-15. Another 100%, also $4 million on Standard Form 25-A. Step 4, insurance. Because this is a fixed price construction contract, FAR 28.306 governs, and there are no FAR mandated minimum coverages. Acme buys its own program. Workers' comp at statutory levels, general liability, auto, and builder's risk for the work in progress. If any of the work is on a government installation, for example, mobilizing equipment from a courtyard, Clause 52.228-5 also applies. The bottom strip summarizes the security posture, an $800,000 bid bond at submission, then upon award $4 million each in performance and payment bonds. That's $8 million of surety capacity Acme needs to secure this single award. These 6 pitfalls account for the majority of bond and insurance problems we see at Neybor Consulting. The red icons are the bid killers, the gold icons are the post-award headaches. Pitfall 1, the wrong bid bond amount. We've said it before, but it bears repeating. Less than 20% in your bid is non-responsive. Either overfund slightly or If your bid exceeds $15 million, just default to the $3 million cap. Pitfall 2, non-listed surety. Always check Treasury Circular 570. Don't take the broker's word for it. Pitfall 3, late bond delivery. Bonds must be in the contracting officer's hands before the notice to proceed. Build at least a 2-week cushion. First-time bond issuance with a new surety often takes longer than you expect because of underwriting. Pitfall 4, in gold. Forgetting to bond change orders. When the contract value goes up through a modification, the existing performance and payment bonds do not automatically follow. The contracting officer is supposed to require additional bond writers for every increase under 28.102-2, and you need to instruct your surety accordingly. Otherwise, you are underbonded and out of compliance. Pitfall 5, skipping consent of surety on bilateral mods. The CO will pause your performance until consent is on file. Add it to your modification checklist. And Pitfall 6, underestimating subcontractor payment risk on non-Miller Act contracts. Without a payment bond, your subs have very limited remedies if you have liquidity trouble. Address it contractually downstream. We've covered a lot of ground. Let's distill it down to 6 learnings you can take with you. 1. Part 28 has 3 subparts that solve 3 different problems. 28.1 bonds, 28.2 sureties, 28.3 insurance. Hold that mental map. 2. $150,000 is the line that everything turns on for construction. Below it, you're in the alternative payment regime. Above it, the Miller Act forces 100% performance and payment bonds. 3. The bid guarantee follows the performance bond. 20% of bid, capped at $3 million. Never required on its own, only when a performance bond will be required. 4. When you can't or shouldn't use a surety, FAR 28.204 gives you 3 alternatives, U.S. Treasury bonds and notes, cash or certified check, or an irrevocable letter of credit. 5. Insurance rules diverge sharply by contract type. Cost reimbursement contracts have mandatory minimum coverages because the government pays the premium. Fixed price contracts leave coverage decisions to you and the market. 6. Your in-solicitation cheat code is a text search for 52.228. Map every clause to a requirement, and you'll never be surprised at award. Memorize these 6, and you will be ahead of 90% of contractors when it comes to Part 28. Thank you for staying with us through 22 slides on FAR Part 28. We hope you now feel equipped to read a solicitation, identify every bond and insurance requirement, and respond with confidence. But knowing the rules and applying them under deadline pressure are 2 different things. If your team is staring down a complex solicitation, struggling to right-size your surety capacity, or trying to decide between an irrevocable letter of credit and a corporate surety bond, we can help. Visit neybor.com to book a one-on-one consultation. We work with federal contractors of every size, from first-time bidders securing their initial bid bond to established primes negotiating multi-million-dollar bonding facilities. We translate the FAR into actionable advice tailored to your business. Click the gold button on screen or simply go to neybor.com. We look forward to helping you win and to keeping you compliant once you do. Thank you and good selling.